This is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, July 1st, 2020. I'm starting it a few minutes before the close. Closing bell will be in about 5 minutes, but we're not going to see anything that makes a material difference on the charts of pretty much anything I'm going to cover here. Start with talk about the financials real quick and the stark underperformance to the broad market, particularly the tech sector. In fact, there's a lot of disconnects really between what the Nasdaq 100 is doing in tech sector, what the stock market's doing. I went over that in an earlier video today. Every major index out there, the Dow, the S&P 500, the Russell 2000 small cap index, the mid cap index, they're all well off their highs, anywhere from 10 to 15, 17%. And here's the financials, and I'm talking the highs back in the last, early 2020, whether you want to call that the end of the last bull market, whether you want to call this a correction within. But this is something to note, because the financials are one of the most important sectors in the economy. It's really, what the stock market is all built on. It's all a house of cards, built, and the health of the banks, and the brokerage firms and investment firms. They're all in XLF. Insurance companies, which are chock full of, bonds, in the credit markets. Everything is all in here. So in other words, a very important sector. Tech sector has a higher growth rate, has a higher weighting on the S&P 500, but this is just again showing you something's going on. And we did to get the news recently where the Fed said that the banks, they don't want them going and paying out all this bailout money that they've gotten from the Fed in the form of dividends and share buybacks. And I don't know the details on that, but again, they were already lagging and they still are. And bottom line is something to note. I want to show you one other thing here. This is what it looks like when we roll back. We have three lines here. I'm comparing three different indexes or sectors. You have XLF in white, the financials. QQQ, which is of course heavily weighted in tech and especially those market leading FANG stocks, and the S&P 500, the broad market. And as you can see, when you look at these, they move in almost perfect lockstep. Now, as far as the trends go, sometimes the financials will outperform or underperform the broad market, but they tend to move in sync, and that's part of a healthy market, as does QQQ and SPY. So again, you can see, yes, financials had a strong rip here, but the broad market, S&P 500 and QQQ were going up as well. They all corrected around the same time, so you can roll it through here. You could replicate this on your own charting platform. Just compare those three, put them on the same chart. And you'll see that, again, it's a near perfect mirror. Lately, this is what's concerning. They all fell into the lows, they all rebounded, and really it was about, off that early rebound is where the financials really started to underperform for a while. The broad market did some consolidating there, had another leg up. Financials consolidated, they had a leg up, but this is what I'm focused on. Really, since the start of early last month, about the first week in June, is when we started to see some pretty unusual disconnects, and you can see everything going in different directions. You can see the Qs all making it to all-time highs today, new all-time highs. Again, they're just doing their own thing, irrespective of the stock market and financials. Right there, we had both lines together. Again, white is the financials, down quite a bit and falling over the last month. The stock market, as I mentioned, is kind of moving sideways. We're back where we were. What was this? Going back in time, that was about the beginning of June right there. So we've gone virtually nowhere in the broad market, but the broad market is also lagging behind the tech sector. So again, this rally and what you're seeing, the lift that you're seeing in the broad market in the green line, the S&P 500, is also largely due to tech, because that's the largest sector. And again, is this a red flag? No, but it's certainly a yellow flag. It's cautionary, and sometimes they will. I'm going to say this: sometimes the financials will underperform, and then they play a game of catch up. They did that last time. But if you continue to see this divergence, and again we go back to that chart I started with, I have XLF at a pretty important support level. In fact, I had that marked a while back at that purple line, 2369. But I'm going to say it's really down now about 23. About where we're at right now is pretty important support, and that I think that's important because you had this this level right here that really capped the first part of the advance We tested, finally broke through, but couldn't hold that level, a breakout. And it's not super well defined. And if we fall down below there, you can see I do have some other support levels, but just something to watch. Again, it speaks to the health of the overall financial system and of the economy. So I'm probably not telling you anything new, anything you don't know. There's the closing bell. So let's take a look at how the markets did today and what levels to watch. I'm not going to spend a lot of time on it. There isn't much to report. We're still well below the sell signals from a few weeks ago with those big candles down on June 11th. And again, as I covered in today's video, we're exactly where we were when we gapped down. That's where the S&P 500 is, and that's all the way back to June 11th. That is in time, what did I tell you before? That is from today, 3 weeks. Exactly 3 weeks ago. There we are. So nothing more to report. That's that. We're down below there. We're in this trading range. What I'm going to do here is I'll just change this box to kind of encompass the whole trading range since that breakdown, and that's what it is. So let's not try to make something out of nothing. We had sell signals. They're still intact, but the market's not really moving down. It's moving sideways, and as I've maintained for the last, for a while now, we need to see, which way this range breaks. That'll likely determine the next major trend. And of course, we have a confluence of support below, a lot of key moving averages, and that's why it's not just that recent trading range. If we break to the downside, we're going to take out all those key moving averages like the 50-day, 200-day exponential, 200-day simple moving average. And if we break above it, well, we've moved back above where the sell signals came. And again, it's going to take out that previous reaction high, and it would be hard to chalk that up to anything but bullish. PPO is still above the zero line, so we'll watch that as well. If you get the downside break, you're probably going to see the PPO cross down below. QQQ, again, it's its own thing. And it's held that 242 level after that brief dip the other day, recovered to close back above it. So successful defense of the 242 level in the uptrend line. So nothing new to note there, except other than we've extended now. I just moved the lines and the divergence is extended. And we have a nice clean rising wedge pattern. If you take a look at this line here, the blue uptrend line, with this divergence line, there it gives you a rising wedge pattern. You want to see, or I prefer to see them confirm with negative divergence. Usually they are. It's the nature of a wedge pattern. Prices start compressing as the trend loses momentum, and then you look for a downside break. Because 242 is so close, you're better off if we were to get a breakdown soon below the uptrend line or the wedge, you'd want to also see 242 go with conviction, and that should open the door to a move down there. And the story remains the same with fewer and fewer stocks, overweighted, mega cap stocks that have the highest weighting on the index and are also, crowd favorites like the FANGs, Apple, Microsoft, Amazon, Alphabet, Facebook. Those were up today, and they carried the Qs up 1.17%. So a respectable gain, but then when you back out the impact that they have with their heavy weighting on the index, you look at something like QQQE. That's the equal weighted NASDAQ 100 ETF. That puts an equal weighting on all 100 stocks in there. And then you were up about less than 0.4%. So almost a third, or actually almost a quarter of what the QQQ, the regular NASDAQ 100, did today. And you can see on that one, it hasn't yet broken out. Now, the momentum's there, whether it breaks out to new highs or not. It should be significant, but most traders are not watching this. They're watching the NDX. But I just wanted to point out, it kind of shows you under the hood, if you collectively what all those stocks are doing, they're really basically testing their highs from back before the big COVID drop off. It's brought us back here, and that's where the NASDAQ equal weighted is. Now let's look at the SPY too. Go back to that real quick. SPY was up about 0.75% today. So, decent gain, nothing huge. And then when you look at the equal weighted S&P 500 ETF, it's telling a much different story. It was down 0.14%. And so there's my chart there, and it's flirting above that. That's the bottom of the recent trading range right here on RSP, the equal weighted S&P 500 fund, 98.27 or so, pretty important level there. So, and the smallies, small caps were down. This is IWM Russell 2000 index. That's the small cap arena. Big level to me is at 145 level. We had a brief whipsaw false breakout above it, and we've been sandwiched below that and really bouncing between here, that 135.83-ish support and the 145, that key resistance level. Again, lots of reactions in the past, and the small caps were down today, but nothing big. PPO is still above the zero line there. RSI is still above the 50 level, and like the S&P 500, I think we need to wait and see which way this breaks. That's most likely to determine where the next decent or tradable trend is. Other than that, it's been chop city in the market. So let's move on to where we can make money, because right now, unless you're day trading, swing traders are just getting grind to pieces over the last 3 weeks, and overall they're down from where the small caps and S&P 500 and everything else peaked a few weeks ago. Yeah, just wanted to kind of loop back to what I talked about in the beginning of the commodities video today. Where I'm seeing opportunities, some of the better risk reward profiles, and that is at this point in time agricultural commodities for one. And then I talked about asset allocation, the different asset classes, which are stocks, bonds, real estate, commodities, precious metals, things like that. And bonds, as I mentioned, have virtually no upside potential, only downside risk. And that's reflected in a couple things are reflected in the chart of IEF. I covered TLT earlier. TLT are the long bonds, the 20 to 30-year bonds. That 30 years as long as U.S. government issues bonds, at least in recent years. And you have IEF, or your mid-range bonds, and unless anything's changed, most of the 30-year mortgages are even more closely related. I've heard in the past to these 10-year bonds, and either way, they're most people don't want to lock up for 30 years. But what you can see here, and it's a similar story, is just this. It's what I call an unnatural price compression, this trading range. It's that ceiling, as I mentioned, because the Feds have brought rates down to near zero. Now they can't directly control the rates on Treasury bonds. They can try to manipulate the rates. What they control, the federal funds rate and the discount rate. Those are very short-term loans made. The Fed makes to banks, or they can make to each other. But indirectly, that will usually impact rates. But market forces are the biggest determinant. And as I said, with rates near zero, there's pretty much a ceiling. That's not to say an absolutely TL or IEF can't go above 122.37. It spiked it there real quick, but again, we'd have to go into pretty steep negative rates to get any more upside. And here's a downtrend line. But what stands out to me is just this unnatural price compression, this trading range, and what the Fed has done by coming so aggressively, intervening into the financial markets, especially the credit markets, is they've removed what, to me, and I think others, is a super critical component of the stock market and the bond market and the financial markets in general, and that's price discovery. Allowing bonds, the natural interaction between buyers and sellers to provide clues to the health of the stock market, to the health of the economy. And we've had trading ranges here, but they're bigger. They're usually some type of trend involved, and this is just quick price compression. In fact, I'd like to show it to you on the futures. This is ZN. These are your 10-year Treasury bond futures. So like IEF, but for a future, those that trade futures. Here was the meltdown, the COVID worries, and we are right back here at the lows. But then once everything got wonky, nobody knew what was going on. There was a flight to safety in treasuries and then an exit. But then this is where we've just locked in trading range between about 137.053 and 139.100. But within there, in that trading range, again, this goes back to early March right here, about mid-March at this point. You can see that almost all, I'd say that's got to be a good 80% or so of the range in ZN has been that midpoint line. I have about 138. You had it here. You drop down to the bottom of the range and you got back above. And again, this is unnatural and unusual price compression. What does it mean? It just, like I said, it's just, to me, not a healthy thing in the market. And it also, you look at the upside potential on bonds. Keep in mind that most of the money out there in the financial markets is in the bond market. It's larger than the stock market. insurance companies, pension plans. They have a lot of money in bonds. They need that fixed income for income and the security, relative security of the bonds to meet obligations. And so they have very little upside potential in price on these, and just a whole lot of downside potential should there be any unforeseen consequences that cause rates to start going up or treasury bonds to start going down, which go hand in hand there. I just wanted to point that out and also say there's very little trading opportunities other than trade the range. If you are a trader, you don't need to make a big move in bonds, just like forex, to make a lot of money because they are leveraged. And you could trade that range. You could watch for a break of 138 and go for a move down to the bottom of the range, or just trade within here. Just wanted to point that out. Really that unnatural, sideways range that we've been in for a while for Treasury. Okay, now back to some of the other things I've been highlighting recently. Gold. I mentioned that in today's earlier video, that sort of that segue leading up to the analysis of the commodities, the agricultural commodities, talking about the different asset classes and where there just aren't a lot of good opportunities now. Gold, like I said, unfortunately, although it's in a bull market overall, it's been in this multi-month sideways range now for a while. So just like S&P 500 traders are spinning their wheels, going nowhere lately, gold traders, unless you're trading the range or actively trading. But we did have what I wanted to point out. I did point out earlier, but in case you missed that video, we got that breakout, that false breakout. Remember I said if we broke out anytime soon, and this was yesterday, we would have negative divergence, which we do. And so gold did have an impulsive break above there, put in a divergent high. As I often say, breakouts that occur with negative divergence and overbought conditions have a considerably higher rate of failing, and that's exactly what happens. You had a very impulsive rejection back down and into the range, and came right up to that trend line. As I was covering, doing the video earlier today, we were right there, and so far have held that level. So where we go from here, look, I'm standing aside the gold trade right now as far as an active trade, because looking at this chart, maybe another thrust up, maybe or not, but with that divergence, I'm leaning towards a downside break and another move down here to any or all these targets, possibly the bottom of the range there. But we're also on the flip side, we're at the top of the range. Gold's in a bull market, so I wouldn't in any way, shape, or form be surprised if we can power on through here, take out the divergences, and move on up. I'd like to let gold show its hand, and I'm seeing the same kind of mixed signals on the currencies. Before I get to the currencies, let me just look at silver real quick for you, and that would be right about here. Okay, here's my silver chart. Again, silver's probably waiting for gold's lead, but it has held this minor uptrend line right here. Bigger picture, going back just for the last few weeks, or going back the last couple months, was a similar trading range. The bottom of that trading range, which I just highlighted here, about 17,258, is pretty well defined. The top is not so well defined. And the last time we tested the bottom of that range, we had a divergent low. That was a catalyst for this rally that was currently going on. This is an uptrend, series of higher lows and higher highs in silver. We also took out the downtrend line, this white downtrend line right there. Again, all these were kind of highlighted as we went along. Breakout there, back test, and we've been moving higher. So for silver traders, here's what you need to watch. Just like that uptrend line on gold, that little wedge I just gave you that we pretty much hit and closed above today, or trading above now, a break above that would, below that I should say, would be bearish. There's a lot of resistance or support levels below in silver. So I'm really, again, on this, not keen right now on taking a position, because a short, it's got its work to do. I like short trades like this. For example, if we got down here and we broke the bottom of the range and there's a lot of thin air meaning you don't see recent trades here. Last time we were traded through that level was this quick up right here, and that's what I call a thin zone. Very few trades occurred at that point. So if I had the volume price histogram bars here on the left, which I don't, not on this chart, they'd be a very, you'd see a thin zone there. A thin zone is akin or comparable to a gap where you have very few traders. So what happens there is if 17,258 is taken out with conviction, you really don't have much support until you get all the way back down here to about that 1590 level. Now look, we're closer to the top of the range, much closer than the bottom. So I don't want to get ahead of myself here, but these are things that we might want to look for on silver. And remember, on those of you that don't trade the futures, this is what silver looks like on the daily chart. You did break out of a triangle pattern recently. It was a breakout candle that was reversed today. We tested the back tested the triangle pattern and that downtrend line. But on gold, and again, gold's going to really determine where silver goes in the long run. You have this divergent high, and you're just above the same comparable trend line that I showed you on gold futures, and you can see the big negative divergences there. The last time gold had negative divergence on the daily chart like this, it led to this sharp drop. So we saw that coming. It was warned in advance. We jumped in. I believe that's where we went long gold on the current official long trade, somewhere here. Yeah, there it is. Bought it there at 139.12. And so far it's been moving up. There's our final target. Are we going to get there before a correction? It depends. Again, I'm certainly concerned with those divergences. I've learned to respect them. So let's just leave it at that. And then you can see if we do pull back, that former T3 level, in fact, there's another level I'll give you right there, a little bit of support that may come into play. And remember, these divergences have played out for corrections in the past, but gold being in the bull market, those corrections proved to be buying opportunities, and there was another one there. So let's move on. So that's the near-term outlook for gold, setting up in a fairly bearish technical posture. And and again, trend lines to watch. As long as we don't break those trend lines, we remain above trend, there's potential those divergences may be burned through. And if not, you need to respect them if they're taken out. Okay, and so in looking at gold, I always like to keep an eye on the dollar, US dollar. These are dollar futures, and we had this downtrend line here that was taken out with the divergent low. That was bullish. That was a catalyst for this rally. Set up with divergent high number 1 and a little rising wedge and a rally right into that 97,585 resistance. Correction 1 from the divergent high. Same, almost an identical pattern here. Same level. We were rejected once again at 97,585. A little brief momentum fueled overshoot, and today we took out the trend line, and we stopped, you can see, right on these levels, same levels I've had on this chart for a while. Support below, support zone runs from about 97,017 down to 96,926, and that's where we so far stopped. This looks like a nice little bear flag continuation pattern, and so if we get this, this should be bullish for gold if it breaks down. Remember, a falling dollar, all other things being equal, is bullish for gold. So if we do get a breakdown out of that potential bear flag continuation pattern, that may be the catalyst to really, it could bring us all the way back down here to my next support, about 96,411, and that should be near-term bullish for gold, or at least provide somewhat of a headwind. Again, if gold breaks down, gets a sell signal, even if the dollar's falling, sometimes gold can fall with a falling dollar, but usually they're going to move inverse to one another. And then the Euro futures E7, you can see here we're at downtrend line resistance, and right here I have a downtrend line that I've added recently, or maybe modified. Let me try to grab the right tool. Here's a downtrend line. We had divergent low here, was a catalyst for this rally, and now we have a comparable divergent low there, and the euro continues to hold or successfully defend this 112-ish support, but we rallied up. So whereas the dollar had a bear flag, we have what appears to be a bull flag here on the euro. So if the euro can pop this overnight or into tomorrow or something like that, you do have resistance right here at 113. It'll probably get checked at least a reaction, maybe a back test. Now an ideal bull flag breakout would see an impulsive move up through there that mirrors the flagpole, or this move up. And again, gold and silver tend to rally when the euro is rallying, because when the euro is rallying, it means the dollar is falling. Otherwise, as I like to say, resistance is resistance until unless taken out. We just hit resistance there. Maybe this is just a rejection. We come on down here, back down to any or both of these nearby support levels. So yeah, it's like I said, kind of mixed signals there. There's some levels to watch that will dictate probably the next move, tradable trend in gold, silver, the dollar, and the euro. I'm just right now pulling back in, keeping things light as far as the indexes go. I'm just not liking the risk reward there or the charts, how they're trading. Like I said, the commodities, they're looking pretty good now. Certain select ag commodities. Wanted to cover a few more that I didn't cover for you today. Let's look at natural gas. Okay, this is NG. These are natural gas futures. You can also trade UNG. Very important. Do not forget that quite a few of those the leverage ETNs that have 3-time leverage ETNs are being retired, and that includes, I believe, UGAS and DGAS. Those are two that we've traded here many times over the years. But the company that runs those and several other ETNs, they're retiring those. So they're going to stop trading on the exchanges. They're going to go to the bulletin board or wherever they go. You want to get out. I think that happens tomorrow. I think they stop trading at the end of the day tomorrow. So if you didn't get that memo and you have any of those positions that includes TVIX, quite a few, drop a note on the comment section here. I'll try to send a link to that and give you some information there. But you do want to most likely get out of those before the close tomorrow. Okay, I had to pause it, take a phone call there, but let's see. I showed you we had the downtrend line, recent breakout. We hit the downtrend line, bull flag there, popped up, ran right into that 786 resistance slash target. Perfect tag of that. When we did so, as pointed out yesterday, we put in a divergent high, negative divergence. That brought us back to back test. So I can say this is an objective long entry on natural gas. You have both back tests of the downtrend line as well as the 16685 support. I would not get married to it. I'd have a stop somewhere south of that, and I would target. We already hit 1786 once. Probably get another react, or we could, who knows? We could get checked there and never get through there. But maybe or not one more reaction. But the fact that we already tagged it once should open the door, especially if we get on through there to that next target at about 191 in NG. Now, the thing about this, why you don't want to, well, first of all, you never want to get married to a trade in natural gas that's going against you, because fewer commodities out there are more volatile and can move, at such a large amount in such short order. I've seen natural gas go up and down, 10%, 15% in a day, and then I've seen it do it again the day after, and keep going. So again, just don't let it get away from you. And what might happen, let's say that we don't hold this support. Again, it's subjective to go long at dual support for the next leg up. But if we do break it, then what I'm looking at here is we have the potential to go on down. We are in a downtrend, an overall downtrend in natural gas. We could go on down, they could run at, and they would probably undercut that previous low. And in doing so, that may give us, it would, if it's a marginal new low and then we reverse, a divergent low right there. And that would set the stage, I think, for a lasting, trend trade, a swing trade that might last a lot longer and give us, probably, I don't even want to quantify it now, but well over 20-30%. Remember, natural gas is at just coming off multi-year lows, had this potential selling climax here, and then a big reversal, which put a big green candle in on the daily, and so it may have bottomed right here. And if it didn't, I would look for another low, put in a divergent low, maybe wait for a buy signal there, some kind of reversal, and that might set the stage. But you may not get this one, so that's why I'm highlighting this entry now. That may be it. Natural gas may be finished with this downtrend. Alternatives to NG are QG, the mini contract, much smaller contract, or leverage size, same prices on the same chart that NG uses. Or remember, you want to stay away from a lot of those 3-time leverage ETNs. Many are already gone to the wayside or will be going to the wayside. So UNG is still around, and that one I've highlighted as a trading proxy, and you can see a little wedge pattern there, a little trend line that has yet to break out but could soon, and that could spark a rally there. Otherwise, we maybe get another leg down, and I'll move this line here. We might get a small divergent low here on the daily chart, or even that 60-minute chart. See, we don't have the divergence yet on the 60-minute chart. I have a line there, but that's not a divergence line. Just like the futures, we'd have to make another low sometime soon, and that gives us then the potential for a divergent low. And finally, I'll just do an update. I didn't cover these two in the video today covering the agricultural commodities, and that is LE we're looking at here, which is live cattle futures, for those of you who like to trade commodities or futures. And there's an ETN COW, cow, which trades live cattle and lean hogs, both of those together. This one, there's a breakout here. You can see a downtrend I have. It's not a very impulsive breakout, and one reason I didn't cover this, it's typically when I'm bullish on the grains, I'm bearish on the on cattle and hogs because of the cost. That's there's usually an inverse correlation there. Grain prices start to go up, that puts profit pressure on the farmers, raise the companies that raise the livestock, because that's an input cost input there. And so either way, we did break out. And we also held support, so I did just want to mention that. And sometimes they do run together. You can see the PPO here is turning up at the zero line. That's a pretty good trend indicator. Bullish when above, bull trend there. And then when you cross, it's the white line I like to use, the signal line. And when that's below, the trend is bearish, as it was from about right there to about right there. And we had a crossover here, bullish. And that zero line often acts as support when tested from above. So you have price support there about 94.23, 94.235. You have a trend line which may continue to be back tested. All I can say is it's objective to go long on around 94.235. Not my favorite. I'm not in it now. I'm watching this one. It doesn't matter if I'm in it or not. I want to share this for those of you that do like to trade these things. And that would be, there's a trading range here that we've been in up to about 101.448. So if we can pop that, that should open the door to that next target there, about 112.84, and potentially all the way up there. Otherwise, break below the 94.235 level. There's a little gap right there below, and so I should add that. And if that gap is taken out, then that's probably going to cause another leg down in LE. And the other one would be HE. HE is lean hogs. They're still below trend. You have a nice, fairly well-defined trend line there. And these things trade pretty well to technicals. You see, you have an uptrend here, defined by an uptrend line. Uptrend goes and goes. You buy back, pullbacks to the trend line until what I like to do. Once you start seeing divergence, that's a heads up. Hey, trend change is likely coming. So that point, I start to look out for a breakdown, a sell signal, which you got right there, a big red candle. That's about as good as it gets. A big impulsive candle. You had a back test if you missed the breakdown for another objective entry, and that was the start of this downtrend that we're still in right now. That downtrend is started to be defined at this point by that downtrend line, parallel price channel. We kind of drop below the bottom of the channel. There's a little minor trend line here. So the bottom line is this: a pop above the trend line normally would be bullish and a buy signal, but you have 5107 for resistance just above it. So that, to be safe, you want to wait for a break at that level. Now you can short it, and that's the MO in a downtrend. Short rallies into resistance, which is the downtrend line. I suspect on this one that we'll probably break this little minor trend line, come on down here, and at that point we might have a setup. There might be a divergent low here to look at, positive divergence. If the indicators do this and prices do that, that would be our divergent low. And at that point we'd be on watch for a breakout above the downtrend line, and at that point also there'd be a little more meat on the bone to swing up to that 51074 level. It wouldn't be just overhead as it is right now. That's why I wouldn't take a breakout if it occurred now, because if we did break out, we'd probably get rejected there and then go on to back test the trend line, or even have another leg down. All right, we'll wrap it up here. Those are some trade ideas, and I'll try to follow up on some of the individual stocks I've highlighted recently. I'll do those in a video, or put up a few screenshots on charts tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.